Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And for tonight's show, we're going a little bit back into the vault in the past. This is an interview I did with legendary investor Jim Rogers, who actually was fortunate to get to meet a couple times back in my days on the New York Stock Exchange. Had a great talk with him. This was probably about 3 years ago, even before the Arcadia channel was a thing. And in either case, you can hear what Jim had to say about silver. I think it is still very much relevant now. And I think especially having seen the things that have happened, having learned about Jeff Curry, having learned about Goldman Sachs, JP Morgan, Ross Benham, CFTC, and all these people who now got caught rigging the silver markets. And then it's going to be fun for me too. Actually, I haven't listened to this one in a couple of years, but I will be excited to listen along with you to hear what Jim Rogers was telling me about silver back a few years ago.
Yeah, they sure do. And perhaps the last question about gold and silver and commodities. Again, a lot of the gold and silver bugs. I remember when we met on the New York Stock Exchange, you took a silver ounce out of your pocket. I was happy because I had just bought my 1,000-ounce block, so I knew I was finally getting something right. But obviously people who've seen the money printing yet bought gold and silver see the prices on the lower side. Curious if you have any thoughts why those haven't responded as much as many people have thought, and if that's still where you're looking going forward along with the other commodities.
Well, I own gold and silver, but I haven't bought any serious gold or silver since 2010. But I own it. I own plenty. Don't worry. If gold goes up, I'm going to make a lot of money. But my view, and I don't know anything about trading, but there was a big blow off in gold in 2011, and nearly always after you have a big blow off, call it a bubble, call it whatever you want to call it, there's a long period of adjustment. Nearly no matter what the market, no matter where, whether we're talking commodities or stocks or anything. My view is that blow off is now working its way out, and that if and when gold goes under 1,000, which would be it would be down over 50% from its blow off top, which often happens, then I would be, I hope, smart enough to buy a lot of gold and silver. I'm not buying any now. I'm watching. I haven't bought any for a long time, as I say, but I certainly haven't sold. So when that happens, if it happens, I hope I'm smart enough to buy a lot. And the reason I say it could happen if we have a bear market. In 2008, gold went down a lot. Gold went down a lot. In previous bear markets, gold has gone down a lot. Now, there comes a time when it goes down less, and then people swamp in to say, hey, let's buy gold and silver to save ourselves. So that time will come. My view, that time will come, and I hope I'm smart enough to be one of those guys who comes in and says, I'm getting me a lot of gold now. Yeah. Because before this is over, Chris, whenever people lose confidence in governments and in money, they always buy gold and silver. Academics will say all day long, that's crazy. Maybe it's crazy. But for thousands of years, all of us poor peasants who don't know it's crazy rush in to buy gold and silver. And I will be one of those poor peasants buying gold and silver, I hope.
Well, there's few people I have more confidence in to be able to spot when that moment occurs. Certainly seems like we're building towards that. And perhaps just in wrapping up, I know you have a new blog and YouTube channel, and perhaps just let folks know where they can find you and stay up to date on all the great things you're doing, and get some of those great books right in time for Christmas. They make great presents.
Well, I'm JimRogers.com, but don't worry, I'm not here to sell things, Chris. I just wanted to have another good conversation with you, and I'm delighted we did it again.
Well, I sure appreciate that. It's been great learning from you over the years, and I appreciate that you share all this information with folks for what's coming. And that said, go get some rest and feel better. Thanks for joining me today, and we'll talk to you soon.
Thank you. I hope we can do it again sometime.
Well, there is the interview with Jim. But before we wrap this one up, I'm also going to play this clip. It's on the channel already, but something always worth seeing again, and for many people who have not yet seen it. Here is Warren Buffett talking about silver the second time he invested in silver. This was back in the 1998 shareholder meeting. And in either case, just as you're listening to this, think about what Warren Buffett, allegedly one of America's greatest investors, is saying about silver and whether those same conditions apply right now.
Good morning or afternoon, actually. My name is Matt Schwab. I'm from New York, Pound Ridge, New York. I actually had a question about the silver purchase last year. When you announced it, you said that you believed that supply and demand fundamentals would only be established at a higher price, reestablished at a higher price. I was just wondering if you could go into more detail about what some of those fundamentals are. I mean, we've read a lot about like battery technology and some other things.
Yeah, we have no inside information about great new uses for silver or anything of the sort. But the situation, and you can get these figures, and they're not precise, but I think they're in general they're generally accurate. You can see from looking at the numbers that aggregate demand, primarily from photography, from industrial uses, and from ornamental jewelry type uses, is close, call it 800 million plus ounces a year. And there are 500 million or so ounces being produced of silver annually, although there will be more coming on in the next couple of years. There's more coming on right now. However, most of that silver is produced as a byproduct in the mining of gold or copper, lead, zinc, so that since it's a byproduct, it's not very responsive to price changes, because obviously if you've got a copper mine and you get a little silver out of it, you're much more interested in the price of copper than silver. So you have 500 million ounces or so of mine production, and you have 150 million ounces or so of reclaimed silver, a large part of which relates to the uses in photography. So there's been a gap in recent years of perhaps 150 million ounces, but none of these figures are precise, which has been filled by an inventory of bullion above ground, which may have been 1.2 billion or more ounces a few years back, but which has been depleted. And no one knows the exact figures on this, but there's no question that the bullion inventory has been depleted significantly, which means that the present price for silver does not produce an equilibrium between supply as measured by newly mined silver plus reclaimed silver and usage. And that eventually something will happen to change that picture. Now, it could be reduced usage, it could be increased supply, or it could be a change in price. And that imbalance is sufficiently large that even though there is some new production coming on, and there's the threat of digital imaging that will reduce silver usage perhaps in the future in photography, but we think that that gap is wide enough so that it will continue to deplete inventories, bullion inventories, to the point where a new price is needed to establish equilibrium. And because of the byproduct nature, which makes the supply inelastic, and because the nature of demand, which is relatively inelastic, that we don't think that price change would necessarily be minor. It's interesting because silver has been artificially influenced for a long time. You saw that movie about, it was William Jennings Bryan, who was editor of the Omaha World Herald and a congressman from Nebraska, and whose brother was governor of Nebraska, who was the big silver man, and they used to talk 16 to 1. The 16 to 1 ratio, I think, goes back to Isaac Newton when he was master of the mint. Charlie will know all about that because he's our Newtonian expert here. But that ratio had kind of mystical significance for a while. It didn't really mean anything. And in 1934, the government passed an act called the Silver Purchase Act of, surprisingly, 1934, which set an artificially high price for silver at that time, when production and usage was much less. And the U.S. government ended up accumulating 2 billion ounces of silver. Now, this was at a time when demand was a couple 100 million ounces a year, so you're talking 10 years supply. So there was an artificially high price for a while. By the early 1960s, that became an artificially low price of $1.29. And at that time, I could see the inventories of the U.S. government being depleted, somewhat akin to what inventories are being depleted now. And despite the fact that Lyndon Johnson and the administration said they would not demonetize silver, they did demonetize it, and silver went up substantially. That was the last purchase we had of silver, but I've kept track of the figures ever since. The Hunt brothers caused a great amount of silver to be converted into bullion form, including a lot of silver coins. So they again increased the supply in a very big way by their action in pushing the price way up to the point where people started melting it down. So you had these dislocations in silver over a 60-plus year period, which has caused the price to be affected by these huge inventory accumulations and reductions. And we think right now that, or we thought last summer when we started buying it, that at the price we bought it, that was not an equilibrium price, and that sooner or later, and we didn't think it was imminent, because we don't wait till things are imminent. You know, we were going to buy a lot of silver. We didn't want to buy so much as to really disrupt the market, however. We had no intention of replaying any Hunt scenario, so we wanted to be sure we didn't buy that much silver, but we liked it. Charlie?
Well, I think this whole episode will have about as much impact on Berkshire Hathaway's future as Warren's bridge playing. We've got a line of activity where once every 30 or 40 years you can do something employing 2% of assets. This is not a big deal for Berkshire. The fact that it keeps Warren amused and
yeah, I didn't like
not doing counterproductive things.
It makes me feel better about all those pictures that people take over the weekend. They all use a little bit of silver.
At least it shows something that teaches an interesting lesson. Think of the discipline it takes to think about something for 3 or 4 decades, waiting for a chance to employ 2% of your assets. I'm afraid that's the way we are. It means there'll be some dull stretches.
Right. Yeah, it's less than $1 billion in silver. It's $15 billion in coke. You know,
it's a non-event.
It's $5 billion in American Express. I mean, it is close to a non-event, but if you see it there,
at least it shows the human personality at work. Very peculiar personality, I might add.
Yeah. Reinforced by a partner.
Yeah.
Well, there is today's show. Thank you so much for being here. Hopefully this was helpful so you could see what other people are saying about silver and why, despite a lot of the challenges that are presented to often take silver from people or convince them to sell their silver in these times, which seems counterintuitive. I think a lot of things are unraveling, a lot in mind-boggling ways, of which silver, I do believe, and this whole paper charade will be included. But either case, hopefully this was helpful tonight just to hear, not just from me again, but from some other investors who have a track record and what they think about silver. So with that said, be safe out there. Go have a great weekend. I love you, and I'll see you again soon.